Average American spends $18,000 a year on non-essentials. Restaurants, food, drinks on Friday night, takeout food are the major non-essential categories that Americans spend their money on. And after the World War II, consumerism really took off in the US, and the period between 1950 and 1960 is considered to be the golden age of consumerism. Apart from higher production volumes during and after the war period, the first universal credit card was introduced by Diners Club in 1950, and later in 1958, American Express issued their first travel and entertainment card. And this is when consumers started picking up pace even more, with Americans buying more and more non-essential items such as golf clubs, hair dryers, and even TVs. Just in the past 17 years, the amount of consumer debt almost doubled, going from $8 trillion in 2004 to almost $16 trillion by the end of 2021. Getting more and more non-essential items on credit leaves less and less money to be saved for the rainy day. According to the recent study, the median savings account in the US is $3,500, and the median emergency fund is $2,000. According to the Federal Reserve data, 35% of adults in the US won't be able to cover a $400 emergency expense at any given moment, to say the least, about the minimum required emergency fund of at least 3 months of necessary expenses. But as a rule of thumb, you should have at least 6 months of necessary expenses in the form of cash or cash equivalents, such as, for instance, cash sitting in your savings account. I personally don't have any cash sitting in the savings account because I'm allowing myself to have a little bit more risk with my savings by putting this money to work. But I'm not here saying that you shouldn't have it. If you have 3, or even better, if you have 6 months of emergency fund in form of cash sitting in your savings account, that's fine. But here I just wanted to talk to you about what you can do if you have a little bit more afterwards saved up. Or maybe if you can afford more risk like I do, then you can also put all your money to work right away, and that is by investing in the stock market. So first, let's talk about why you should invest in the stock market instead of leaving your money idle and sitting in the savings account. And the first reason is inflation. You might have heard about it, but if you haven't, inflation in the most simple term is the reduction in the purchasing power. Meaning that what you could buy for $1 in 1950 in 2022 is going to cost you $11.67. And that means that money sitting in your savings account is going to buy you less and less over time. And you are making some interest by having your money in the savings account, but even the best savings account nowadays offer around 0.5% interest yield, while the inflation in the past 10 years in the US has been sitting at around 2.47%, meaning that you're losing almost 2% in the purchasing power due to inflation. And in the past several months, due to supply shortages and money printing and all that influx of money to support the economy during the COVID times, now the inflation has been sitting at around 7% by the end of December 2021, and by the end of January 2022, it's sitting at around 7.5%, meaning if your money is sitting in the savings account, you're losing almost 7% of that money just by having it in the savings account. That's why investing in the stock market is a better way to put your money to work instead of letting it sit idle in your savings account earning 0.5%. If you're worried about investing or you're completely new to investing, don't be afraid, because if you're thinking about long term, there is nothing to be worried about. Because if we look at the S&P 500, which is an index consisted of the 500 largest companies in the US, which is also referred as the indicator of the US economy, we can see that there were periods where it was going down for a while and then it was going up. But if we look at the overall trend over the past 40 years from 1982 to 2022, we can see that there is an upward trend, and the overall market return is 3,744%. To give you a better perspective, if you were to put $1,000 back in 1982 into the stock market, today, you would have a return of $37,448. But if you were to put this $1,000 40 years earlier into a savings account earning 0.5%, that money right now would be worth $1,222. And that brings me to another reason why you should invest in the stock market, and that is to prepare for retirement, which is something that you should start thinking about at the early stages of your life, considering how the average Social Security benefit is $1,657 and the maximum Social Security benefit is $3,345. So this is definitely something that you should take care of on your own. As you've seen in the previous example, if you invested $1,000 in 1982, today in 2022, it would be worth $37,448. Can you imagine how much it would be if you were to invest consistently a small amount of money over the period of 40 years? At this point, you would exercise the power of compound, which is the most powerful tool to accumulate wealth over a long period of time. And a small disclaimer here, I do not consider it to be the fast way by any means. You should not rely on it as your primary source of income if your monthly contributions range between $100 to $1,000. It's a good way to preserve wealth and most likely become wealthy by your retirement age. But by no means do I consider it the primary wealth accelerator. The best wealth accelerator is your business that brings in profits and has the value of its assets growing over time. You most likely won't get wealthy with small contributions into the stock market over a short period of time, which I consider to be around 5 to 10 years. But that's the topic for a completely another video. If you're an employee, some companies offer a retirement account known as 401k. And if you have an option, I would suggest that you take it, especially if your employer does 401k matching. Meaning that for every dollar that you put out of your paycheck into your retirement account, your employer is going to put $1 extra at their expense. That is basically extra money that you're being paid by your employer out of their pocket and goes straight into the stock market and compounds month by month. The size of the match totally depends on the company. They have different policies, but it can be up to 5% match, meaning that for every 5% that you put out of your paycheck into your 401k account, your employer is going to put 5% extra at their expense. And that money that you put out of your paycheck into 401k is pre-tax, meaning that it's going to reduce your taxes on your current income. When I'm talking about investing, I mean investing long-term, because oftentimes people confuse investing and speculating. When you're buying a stock to sell it in the next few hours, days, or even month, then you're speculating to make quick money. And that is highly risky and requires a lot of research, and that is a way for day traders to make money when they buy and sell stocks in short periods of time. But I'm here talking about the long-term investment, meaning that you're buying a stock and you're holding it for a long period of time that can last several years or even tens of years. And the most risky way to invest is to try to time the market, because the market goes up and down in cycles. But if the overall trend is positive, then you should be good. Because as you can see from the S&P 500 graph, in October 2007, it was sitting at 1561. And that's when the recession started to happen. And later in March 2008, it dropped almost 50%. Meaning that if you were to sell all your stocks at that time, you were to lose 50% of your money. And if you were to sell those stocks anytime in the next 5 years, you would still be at a loss, because it took the market almost 5 years to recover to the level of October 2007. But if you were to wait another 6 years till November 2019, your investment would have doubled. That's why timing the market is the worst thing that you can do, because nobody knows where the market is going to go in the future. So how do you invest then? Well, as I've already said, the best way to invest is to put same amount of money every month into the stock market. And that process is called dollar cost averaging, meaning that you're going to invest the same amount of money into the stock market every month, and you're not going to look at what's happening to the market right now, but just keep investing no matter what. The average return of the S&P 500 index, the one that I mentioned earlier, is sitting around 10.5% annually. So let's assume that you're putting $100 every month into your savings account that yields 0.5% over the course of 20 years or 240 months. Then your money after 20 years would be worth $25,235. But if you were to put the same amount of money, $100 every month, into S&P 500 index that yields 10.5% annually, then your money would be worth $81,057. And you don't even have to know how to pick individual stocks. Instead, you can just be buying into index funds such as S&P 500 through ETFs or exchange traded funds. ETFs, they're basically buying a basket of securities or a basket of all these 500 companies, and then they offer you a single security that you can use to track that same index. So it's basically like you're buying into an index fund. And that is the most safe, passive, and the easiest way to invest into the stock market if you don't know how to do it or if you just don't want to deal with it. And that was it for this video. I hope you enjoyed the video. Smash the like button for YouTube algorithm and subscribe for more. In the next video, I'm going to show you how you can sign up and start investing with Robinhood, which is the easiest way to start investing, especially for beginners. Bye.